economies. Our next panelist is Arjuna Mahendran, who just took office as the governor of the Central Bank of Sri Lanka earlier this year in January. And he also brings with him useful and interesting diverse perspectives. Prior to this, he was in the private sector and working for the Emirates NBD and HSBC Private Bank. And also as a former chief investment officer, he has experience with financial markets. And so it's well suited to round off this discussion with his comments, and then we'll throw it open to the floor.
Thank you, Mr. Chairman. First of all, I would like to thank Governor Chitanko and the BSP for the splendid arrangements that you've made here today, which really have made this an outstanding event. I'll try and be brief, given that we are probably running ahead of time. Essentially, what I gathered from today's interventions have been that, starting with Governor Carsten's, I think he made a very, very valid point when he said that monetary policy is doing all the heavy lifting, and nobody's really looking at the need for structural change in economies as diverse as those in the Western world, and including many emerging markets. And as a consequence, we are in this liquidity trap, which is creating all sorts of perverse situations for central bankers to control. And to me, the most egregious issue is that of the pricing of risk. So from Professor Merton's presentation just now, he did point out that we view capital markets in abstraction as this link between savers and investors, and in between you have this whole edifice of instruments to try and control the risk that's inherent in that relationship. But my point then is, if we are in a liquidity trap, are we perhaps possessed of all the necessary tools to correctly price that risk? Because as was pointed out earlier, the preference of investors, a lot of savers, is to move into shorter term investments because the longer term seems a little more unsure. And secondly, monetary policy is now no longer cast in the traditional terms of controlling price stability and financial stability, but it's become more akin to, as was mentioned by Robbie, fixing the risk premium on different types of financial assets. If that is indeed the new objective of monetary policy formulation, then we have a very big task on our hands, as I see it, in terms of ensuring that this entire liquidity trap that we're in ends up in a soft landing. And I don't think anybody in this room can guarantee such an outcome. And all this, to my mind, harks back to the early 2000s when Alan Greenspan, I think, made that famous comment about his conundrum, the fact that when he initially started raising interest rates, the long-term interest rates did not follow the short-term rates. And Bernanke famously explained that down to the glut of savings that he saw in China that had emerged, which meant that there was this excess demand for long-term U.S. treasuries and longer-term instruments. But the point is, this big information communication technology revolution, the emergence of China as the world's factory, all this put together has created massive wealth. And the Chinese deployed that wealth very significantly in the aftermath of the 2008 crisis, when you saw this enormous stimulus to the economy funded by the Chinese banking system, which created a massive commodity boom, which is now unraveling. So, once again, is the pricing of risk, given all these moving parts, going to adequately protect us from a nasty outcome? And I don't think anybody I listened to today said that would necessarily, that we would have a soft landing. And that is kind of worrying. It's a worrying conclusion to this session. But let me just perhaps end by giving you a practical example of how things have panned out in my country, Sri Lanka. And I might also add that just before Professor Merton got up to make his presentation, I asked him about Warren Buffett's famous comment about derivatives being weapons of mass financial destruction. And Professor Merton told me that he knew personally from Mr. Buffett that he only mentioned that in a specific context, but he didn't mean it in general. And I hope that that carries over. But certainly that there are these niggling worries about derivative markets and the mispricing of risk, and I think that's one takeaway that I would leave with you from my perspective. In Sri Lanka, we've seen this pattern of recurring financial cycles. We're a small trading nation just south of India, for those who aren't familiar with our country. And, in our situation, we're heavily dependent on international financial conditions. And clearly, we've seen these waves, starting with the 87 crisis in the US, 97 Asian crisis, and then 2008, you saw the subprime debacle. There is this sort of self-fulfilling prophecy aspect to international financial markets from our perspective, which is that every decade or so you have some sort of a nasty event. And we're sort of girding ourselves for such an outcome in the next, in the near future. I saw this prophetic article by the Economist News magazine last week, I think it was, which said that you had the 2008 US crisis, then the European dislocation in 11 and 12, and the next is going to be the emerging markets. So you have this sort of markets, anticipating these cycles already. And that, it seems, builds itself into the way markets price risk, amongst other things. How does a country like Sri Lanka try and buffet itself against this type of eventuality? Again, as was discussed, we reach out to friendly nations, either on a multilateral basis or bilaterally, to engage in swap arrangements between our central bank and others. So the Bank Negara, Malaysia, helped us in 2009 when the country faced pressure on the currency. We're very grateful to that, and that tided us over some volatility in terms of capital flows leaving the country. And more recently, this year, we reached out to the Reserve Bank of India, which lent us $1.5 billion US dollars to again tide us over some volatility after the change of government in Sri Lanka. This reminds me of Ambassador Tommy Koh's comment a few years ago when he said that Singapore is very promiscuous when it comes to its bilateral trade agreements. So I would say that Sri Lanka has been very promiscuous in terms of the swap arrangements we engage in with our bilateral partners. That I think is one way that we can surmount the lack of multilateral arrangements. I commend the Southeast Asian region for the Chiang Mai arrangement. In the SAARC region, the South Asian Regional Cooperation Group, we have a multilateral swap arrangement between ourselves up to the tune of $400 million between member central banks. But I think there definitely is a need for something really global as we go forward to help us tide this rather difficult period that we anticipate. And finally, coming to the issue of macroprudential controls, which were discussed in the earlier session as well, I think this is also the other new tool that becomes incredibly useful, given that the bubbles that emerge from this excess liquidity that's sloshing around the global markets looking for an investment home, the bubbles that are created by this, most notably the big bubble in gold prices that we saw up to 2012, have real economy effects. And we saw that in Sri Lanka, for instance, as in many emerging markets where gold is a principal form of saving, particularly in rural communities. We saw a very, very big collapse in bank credit to the rural sector as a consequence of the collapse in gold prices, which we're still mopping up as we speak. And I think it's in those sorts of situations where macroprudential measures become very relevant, as indeed was the case in real estate in Hong Kong and Singapore and such like. So this combination of multilateral swap arrangements and the use of innovative macroprudential measures by central banks will, I hope, address this bigger problem that governments, the political establishments across the globe are unable to engage in meaningful fiscal and structural changes, which regrettably have not accompanied the heavy lifting by the central banks in the last decade, and which, as a consequence, are creating this very cyclical behavior, repetitive cyclical behavior that then feeds into expectation formation in the financial markets and remains a significant challenge for us central bankers to surmount in the years ahead. Thank you very much.